Stocks can react very differently to inflation and interest rate hikes. And if you're wondering how that impacts your portfolio or retirement savings, you're in the right place. These factors can cause unexpected swings in the market, and understanding why can help you make smarter, more informed decisions for your wealth. Now, you might be asking, why do stocks react the way they do when inflation rises or interest rates are hiked? First, it's crucial to understand that the stock market is heavily influenced by future expectations, not just what's happening today. When inflation increases, investors start worrying about the erosion of purchasing power. This often leads to higher costs for companies, which affects their profits and, ultimately, stock prices. Inflation can also trigger fears of tighter monetary policies, which we'll get to in a minute. On the other hand, when interest rates go up, the immediate reaction in stocks is often negative. Why? Higher interest rates make borrowing more expensive. For businesses, that means higher operational costs. For consumers, it reduces disposable income. This can slow down consumer spending, which drives down demand for products and services, and in turn, affects the earnings of companies. Now here's where things get tricky. While inflation and interest rate hikes often create pressure on stocks, there's a flip side. Some industries and companies might actually thrive during times of inflation. For instance, companies in the commodity sector, like energy or mining, may see their stock prices rise as inflation drives up the prices of raw materials. But this is more of an exception than the rule. For the average investor, rising inflation and interest rates typically mean reduced growth in the stock market, and that can affect your long-term wealth, especially if you're approaching retirement. If you're serious about protecting your wealth in the next 2 weeks, I strongly recommend you check out the first link in the description for the free Gold IRA guide. Thousands of Americans are opening Gold IRAs to safeguard their savings against inflation and interest rate hikes, and it's one of the best moves you can make in these uncertain times. Gold has been a stable store of value for centuries, especially when other investments are volatile. It's a smart way to preserve your wealth when the stock market is unpredictable. Now, while stocks are often the go-to for many, they can't always shield you from the impacts of inflation or interest rate hikes. That's why more American retirees are turning to Gold IRAs as part of their strategy to diversify and protect their wealth. Gold typically performs well during times of economic uncertainty, making it a powerful hedge against market downturns or economic slowdowns triggered by inflation or higher interest rates. The key here is balance. You want to ensure that your retirement savings aren't tied solely to stocks, which could take a hit when inflation rises or interest rates go up. Having a portion of your savings in a Gold IRA ensures that you're prepared for these economic shifts. This is especially true if you have a substantial IRA, 401k, or savings, whether it's 100k, 1 DAMers, or even 5 man or plus. I'm sure you've heard the phrase, don't put all your eggs in one basket. It's a timeless piece of advice that applies to investing. By diversifying into Gold IRAs, you can stabilize your portfolio and reduce the risk that comes from stock market volatility. This is crucial for anyone nearing retirement age who is looking to preserve their wealth for the long term. So, if you have 100k or more in your IRA, 401k, or savings, now is the time to take action. Make sure you're protected against inflation and interest rate hikes by diversifying into a Gold IRA. It's one of the best decisions you can make, and I encourage you to check out the free guide linked in the description. You'll get all the information you need to make an informed choice and protect your wealth for the future. Remember, it's all about being proactive with your retirement planning. Don't wait for the market to surprise you. Take control now, before it's too late.